So now we're recording. Share my screen. Let's go into my business course. And let's go to the ebook. You go into the exercises at the end of chapter 3. And then here's the Microsoft Word document, which I uploaded to Blackboard, which has the practice problems you can do from recommended practice problems. And so today we're going to, in chapter 3, we're going to do exercise 3.2a first. And I'll upload this document that I'm writing to Blackboard after the lecture. How do I get this thing at the top of my screen to go away? I don't know if it's on the recording. All right, there, it went away. I don't think it's being recorded, but 3.2a. All right, this exercise, we're doing adjusting entries. I mean, that's the whole chapter 3, adjusting journal entries, essentially, along with the closing process. There seems to be a little bit of lag between what I'm doing on my tablet and what you see. I can see the lag. So hopefully that will clear itself up. All right, selected accounts of Ideal Properties Incorporated, which is a real estate management firm, are shown below as of January 31st, before any adjusting entries have been made. So they give you these different accounts and their balance at January 31st. It's the unadjusted balance. It says they prepare monthly financial statements, which means at the end of each month they have to make adjusting entries. Using the following information, record a journal entry, record the necessary adjusting journal entry as of January 31st. So let's take part A, prepaid insurance, which has a debit balance of $7,200 at the end of January before adjustment. That represents a 3-year premium that we paid on January 1st. So for part A, I would make a T account. And there's $7,200 in the prepaid insurance account before adjustment. That's the balance. But we need to make an adjustment. And then the account will have an ending balance. We need to take some dollars out of prepaid insurance. The question is how much? So on January 1st, we paid $7,200 was that a 3-month or 3-year? It said 3-year. On January 1st, we paid $7,200 for an insurance policy. Now we're at January 31st, and 1 month has gone by. We've been insured for 1 month. So we've derived the benefit of being insured for 1 month. So we have incurred insurance expense. And our prepaid insurance account has declined by that amount. So we're going to debit insurance expense, credit prepaid insurance. For how much? Well, whatever X is. So the $7,200 represents 3 years of insurance. So how much are we paying for 1 month? We just need to take 7,200 and divide it by the 36 months. So essentially we're paying 200 a month. I mean, we pay all 7,200 at the very beginning, but really that's 200 per month that's what it's costing us per month. So after 1 month goes by, our prepaid insurance account should only have 7,000 in it, because we've already used up 1 month worth of that 7,200, which was worth $200. We've been insured for that month. We can't be insured again for that month. The month's already over. So we have to reduce our prepaid insurance. And then our insurance expense, again, reflects the fact that we've incurred an expense. We've derived the benefit from using a resource, using an asset. That's the definition of incurring an expense. So this is the answer. This is the adjusting entry. They don't ask for the ending balance in prepaid insurance. They don't ask for it. They just want you to make the adjusting entry. Part B. Supplies of $975 were on hand at the end of the month. And you say, wait, it said that the ending balance in supplies on January 31st was $2,100, right here. But that's before any adjusting entries. And what they're saying in Part B is the ending balance in supplies should be $975 after adjusting. So the adjustment then, if we make a T account for supplies, there's the balance before adjustment. They said the balance after adjustment should be $975. That's the amount that's on hand at the end of the month. After they looked in the supplies, after they looked in the storeroom and they saw the supplies that were sitting there and they calculated the value, there's only $975 left. The value would be, for each thing that's sitting there in the storeroom, they went and looked at, they have an invoice they originally paid for each of those things. They add all the dollar values up. There's only $975 there, which means we've used up some supplies, right? We've derived the benefit from using supplies. So that's supplies expense. And we reduce supplies. So debit supplies expense. Credit supplies. What's the dollar value of the supplies that we've used? We have to solve for it. So 2,100 minus X equals 975. So that implies that X equals, what is that? $1,125, it looks like. So 1,125. This is the journal entry. This is the adjusting journal entry that they want. Hopefully this is making some sense. Right here, I probably should have put parentheses around this. Put a star. That's how I do this. So if I have some number with a star by it, the star means I calculated it a certain way, and you got to go find the star that indicates how I calculated it. All right. Part C. Office equipment is expected to last 8 years. Depreciation is recorded monthly. So they're wanting the adjusting entry for depreciation expense. That's what they're wanting. Excuse me. So remember, how do we find the depreciation expense per month? There's a formula. It's what we originally paid for the asset, in this case, the office equipment, minus the salvage value of the asset. So it's the asset's historical cost minus the salvage value divided by the asset's useful life. All right. The office equipment account at the end of January is sitting there with a balance of $76.80. Since that's a long-term asset, the balance in that account will always stay at $76.80. We won't reduce it unless we sold the asset. Then we would reduce the balance. We don't reduce the balance in the office equipment account for depreciation, right? The way we do that is we increase the balance in the accumulated depreciation account, because there's a contra account for each long-term asset other than land. There's a contra account called accumulated depreciation, and that's the account we record the depreciation in. So that $76.80 is what we originally paid for the equipment. That's the historical cost. And the salvage value of the equipment, it doesn't give us any information about salvage value, and so when it doesn't give you any information, then you assume that the salvage value is 0. Salvage value is what the equipment, what we expect to be able to sell the equipment for at the end of its useful life. And its useful life down here, we estimate it to be 8 years. We could use this equipment for 8 years, and then after that, it's not useful to us anymore. It doesn't mean it's worthless. It doesn't mean we couldn't sell it for something. It just means, well, in this case, it means since they didn't tell us anything about salvage value, we assume at the end of 8 years, we're not going to sell it for anything. But some things like laptops, for example, they have a useful life to me of about 2 years, after which I get a new one. But I could sell it at the end of 2 years for some positive number. Right? The amount at which I could, what I expect I could sell it for at the end of 2 years, if that's its useful life to me, that would be the salvage value. In this case, salvage value is 0. Useful life is 8 years. 8 years, though, we want the depreciation per month because we're doing this monthly. It said monthly financial statements are prepared. We're finding these adjusting entries at the end of the month. So we would do 8 years times 12 months per year. And so we're taking $76.80 and we're spreading it out over 96 months. And so the depreciation we recognize each month is, now I have to calculate because I can't do that in my head. $76.80 divided by 96. $80. All right. The adjusting journal entry, we debit depreciation expense for $80. And we credit not the equipment account, but we credit the accumulated depreciation dash office equipment account. We credit the contra asset account. This is the answer. So that's what the depreciation expense journal entry always looks like. You always debit depreciation expense, credit accumulated depreciation. Let's go to part D. On January 1st, the firm collected 6 months rent in advance from a tenant who was renting space for $925 a month. They basically gave us the number. So we're a landlord. We're not renting space. We are the rentor. We're the ones we're renting the space out to a tenant. Previously, when we talked about rent, we were the person renting the space from the landlord, but we're the landlord here. We've collected money in advance from a tenant, and in return, we allow them to occupy a certain space for 6 months. So we must have collected from them $925 times 6. But only 1 month went by. So only 1 month's worth of rent revenue do we get to recognize. So 1 month has gone by. we've earned the revenue, right? Because we provided the service for the client. In this case, what are we providing? We're providing the client the right to occupy that space. So we've done that. And so we've earned $925 of rent revenue. So we would credit rent revenue. How do we make rent revenue go up? We credit it. And we would debit unearned rent revenue. So this is the right entry. What is unearned rent revenue? If we look on the company's accounts, they do have an unearned rent revenue account. See, there it is. It has a balance of $5,400 at the end of the month. Unearned rent revenue represents money that's given to us by our tenants at the beginning of a month, and we have a liability to them. Once they've given us that money, we have a liability. We have to allow them to occupy that space for the month. And so when 1 month goes by, we can reduce that liability because we've allowed them to occupy that space for that month. And how do we reduce a liability? We debit it. So that's why we're debiting unearned rent revenue. It's a liability. When they pay us the money at the beginning of the month, what's the journal entry? We would debit cash. We would credit unearned rent revenue for how much ever they paid us. This entry was made first, before this entry. And then once the month goes by, we recognize the revenue. So this adjusting entry we're making here, this one that's circled, it's an example of a deferral, right? Cash happens first, we receive cash first, and we defer the recognition of revenue until later, whenever we actually earned it. Or E, accrued salaries not recorded as of the end of January are $625. This means our employees have worked for us during January. We owe them $625. We haven't paid them yet. Have we incurred an expense, even though we haven't paid them their wages yet? Most definitely we've incurred an expense. Why? Remember, we incur an expense when we derive a benefit from using a resource or an asset. Have we derived the benefit from them working for us now that the month has passed? Yes. All those things they did for us that month, we've derived the benefit. So we've incurred what is called salaries expense. So we debit salaries expense. For $625. If we paid them cash right then, we would credit cash, but we didn't. So we would credit a liability, salary payable. Salaries payable, I should probably make sure I stay consistent here. Salaries payable, $625. And then later, whenever we actually pay them, we would debit salaries payable, credit cash. So this adjusting entry is an example of an entry that you do first and then the cash happens later. So this is an accrual. This is a deferral. This is an accrual. If you want to go by our categories that we talked about last time. It's not so important that you know for a given adjusting entry what category it is. What's important is you know how to make the adjusting entry. That's the main thing. So I guess I don't need to circle these because it's obvious they're the answer because that's the only thing I have. Whereas over here, I had a lot of different things, so I need to circle the answer. And another thing I want to point out, some students wonder what's the difference between salaries and wages. Salaries are what you owe employees, are fixed amounts. It doesn't depend on how many hours they worked. If that's the way you're paying this particular employee, that's a salary to them. And to you, it's a salaries expense. Wages are monies that you pay an employee that are depend on how many hours they work. So that's wages expense to you. But if you can use the terms interchangeably if you want, and I won't be too much of a stickler on salaries versus wages. But you should get in a habit of trying to be as particular as you can about that. So we have a question. Vince asks, could you show what the accrual expense would look like for salary at the beginning of the month? That's not how wages work. You don't get paid in advance. You're an employer, you don't pay your employees in advance. They work for you first, and then you pay them. So there would never be, you pay your employee at the beginning of the month for the work that they haven't done yet. So there isn't an example. I mean, if you did pay your employee at the beginning of the month for work that they haven't done, you would credit cash when you paid them, debit some liability like, I don't know what you would call it, unpaid employee wages. And then when you pay them at the end of the month, you would debit wages expense, and you would credit unpaid wages. No, that's not right. If you paid them at the beginning of the month, yeah, you would credit cash. What would you debit though? You can't debit an expense because you haven't derived the benefit from them working for you yet, because the month hasn't passed. You're at the beginning of the month. So you would debit some asset, like that money you've just paid is giving you the right for them to have to work for you. So I don't know what you would call it. And then at the end of the month, you would debit the wages expense and credit that thing that you debited at the beginning of the month. But employees aren't paid that way, so let's not even go down that road. Employees are paid after they work for you, not before they work for you. So I won't go down that road any further. Good thinking, though. All right. You're welcome, Vince. The next one we were going to do, according to our document here, is the 3.3a. So let's do that one. For each of the following unrelated situations, prepare the necessary adjusting journal entry. A, you haven't recorded depreciation on equipment, and you need to record it, $800. You guys know the journal entry for depreciation. It's always debit depreciation expense. I wrote out everything this time instead of just abbreviating. And credit accumulated depreciation dash whatever long-term asset we're depreciating. In this case, equipment. Part B. The supplies account has a balance of $3,100. Supplies on hand at the end of the period totaled $1,200. So clearly they're asking for the adjusting entry to recognize supplies expense. So make a T account. They're giving you stuff about information about balances. And remember when I told you, if they give you an account and information about its balance, make a T account. The balance is $3,100 before any adjustment. After adjustment, there should be $1,200. And we must take some out of this. We must have used some supplies. The dollar value of supplies we used has to be reduced from the supplies account, and that's supplies expense. So we'll debit supplies expense for X, credit supplies. Question is, what's X? Just solve for X. 3,100 minus X has to equal 1,200. So X equals 1,900. So there's the adjusting journal entry for this situation. C. On the date for preparing financial statements, the company estimates they're going to have to pay utilities of $425. That's the estimated dollar value of utilities they feel they've used that period. But they haven't received a bill yet. Well, it's still a liability to them. So it's still utility payable. Credit utilities payable. And have we derived a benefit from using a resource? Most definitely, we've derived a benefit from being able to use our electricity. So utilities expense. We've definitely incurred an expense. So this journal entry would be made. Now you might be wondering, all right, fine, they make that journal entry. And then what if they were wrong in their estimate? What if they used $500 worth of utilities? So they get the bill a few days after making this entry and it says 500 is what they owe. Then what are they supposed to do? Well, then they're going to have to recognize an additional $75 of utility expense and recognize an additional $75 of utilities payable. And then when they pay it, they can reduce the utility payable with a debit of 500 and credit cash for 500. What if it was the other way? What if they overestimated? What if the bill says they only owe $400? Well, then they've recognized too much utility expense. So we would have to reverse this journal entry. So you would debit utility payable for 25, reduce the liability by 25, reduce the utility expense by 25 with a credit. And then the correct amount of utility expense and utility payable would be recognized of $400. And then whenever they pay it, then they can get rid of the utility payable and credit cash. But as far as just given the information we have, this is the journal entry they made. On the first day of the current month, the company paid rent for 4 months. They paid $2,800. They recorded it as a debit to prepaid rent and a credit to cash. So when they paid rent is paid in advance. So they debited prepaid rent, credit, cash. We pay the landlord $2,800 for the right to be able to occupy a space for 4 months. Have we incurred an expense yet as of the beginning? Nope, we haven't incurred an expense because we haven't derived the benefit from using an asset yet. We haven't derived the benefit from occupying the space because it's at the beginning. So let's make sure this says on the first day of the current month, they paid us $2,800. Now it says, and now where are we? We're at monthly statements are now being prepared. So now we're at the end of the first month. So this isn't the adjusting journal entry, but the one they're asking for. What's the adjusting journal entry? It's the one to recognize rent expense. We need to recognize 1 month's worth of rent expense. Debit rent expense, credit prepaid rent. What is 1 month's worth of rent expense? So this is day 1 of the month. This is last day of month. If a 2,800 is a 4-month, we're paying 2,800 for the right to occupy the space for 4 months. So in essence, what are we paying per month? $700, right? So this is the journal entry. And again, how did I get to 700? Put a star by that. 700 was calculated by taking the amount we paid for the 4 months and dividing it by how many months that we're paying for. E. All right, now this one, you have to read it carefully. It says 9 months ago, so 9 months from the standpoint of where we are right now, and we have to make our adjusting entry from the standpoint of where we are now. From this standpoint, 9 months ago, we, Solid Insurance Company, sold a 1-year insurance policy to a customer, and they paid us $800. That happened 9 months ago. They paid $800 for the right to be insured for 1 year, for 12 months. And from the standpoint of right now, that happened 9 months ago. So originally, when we received their cash, we debited cash, $800, and credited a liability, unearned, essentially unearned revenue, but they call it unearned premium revenue, unearned insurance premium revenue. We received their insurance premium already. And this is how insurance works as well. You receive the cash from the customer in advance, and then you have to insure them. You have a liability to insure them for a certain amount of time. In this case, we have to insure them for 12 months. So unearned premium revenue was credited. Now the end of the month is here. No. This journal entry was made 9 months ago. It says here, no adjusting entries have been prepared during the 9-month period. Annual financial statements are now being prepared. So what's the adjusting entry 9 months later? Well, we as an insurance company need to recognize that we have earned 9 months worth of insurance revenue because we've insured them now for 9 months. They've been insured for 9 months. So we've earned the right, we've earned the revenue. At any time during the 9-month period, they could have, filed a claim and we would have to pay out. So we have to recognize insurance revenue. The adjusting entry. Now, which is 9 months later, 9 months after this first entry, is to credit premium revenue. And we debit the unearned premium revenue because we've satisfied 9 months worth of our liability. We've insured them for 9 months. At any time, they could have filed a claim with us and we would have had to pay them. So we have satisfied. All right, this $800 they originally paid 9 months ago was to be insured for 12 months. So how much revenue do we get to recognize if only 9 months have gone by? We can't recognize all 800. We have to only recognize 3/4 of 800, right? Or 600. And again, how do I calculate 600? So this is the answer. It's $800 for 12 months. So multiplied by only 9 over 12 months have happened. So 800 times 3/4 is 600. This E is a great example of you got to pay careful attention to the wording, the timing. F, at the end of the accounting period, Employee wages of $1,050 have been incurred but not paid. We owe them $1,050, credit wages payable. We increase the liability with a credit. What do we debit? Have we incurred an expense? Yes, we have derived the benefit from them working for us. So we've incurred wages expense. G, at the end of the accounting period, $411 of interest has been earned, but not yet received on notes receivable that are held. So what are we? What kind of firm are we? Who makes our money from interest on money that we've loaned out? We're a bank, right? Previously, we've talked about interest from the borrower's perspective. We talked about interest expense, interest payable, notes payable. Now we're talking about interest from the lender's perspective. We're a bank, we're a lender. So at the end of the accounting period, we have $411 of interest that is owed to us, but it hasn't been paid to us. We haven't received it yet. So we've earned $411 of interest revenue. And we have $400 of interest receivable that is owed to us. Debit interest receivable, credit interest revenue. Depending on the terms of the loan, we will get our interest, sometime in the future. Plus, we will get the original amount that we loaned to them, which we call that a note receivable from our side. But here's the adjusting entry for the interest. Revenue goes up, assets go up. All right, that's exercise 3.3a. Let's do 3.6a. If you guys have questions as we're going, please stop and ask, and I will answer them as we go. This should be an easier one. I'm going to let you guys help me with the answer. We can type into the chat. Somebody have a question? No. All right. Revenue recognition. All right, let's go back to what we learned last time. When does GAAP say you have to recognize revenue as a company? When you've earned it. When have you earned revenue according to GAAP? Whenever you've provided the goods or done the services for the customer. Whenever you've either provided the goods to the customer or you've done the services for them. That's when you've earned it. That's when you recognize revenue. So with that in mind, Part A. Honey Industries sells a machine in January with terms of no payment, so the customer doesn't have to pay Honey Industries until 6 months later. When does Honey Industries recognize revenue? There's only two possibilities. It's either in January or whenever they receive cash in June. What do you guys think? One person said 6 months later. Other people are saying in January. January. Remember, I'll state it again. The revenue recognition principle says that a company recognizes revenue whenever they've earned it. And further, it says a company has earned revenue whenever they have either provided the goods to the customer, provided means shipped them, delivered them, or if they have to do a service for the customer, they've done the service. Whenever either of those two things, then they've earned the revenue, they recognize it. It doesn't matter if the company has paid them or not. It doesn't matter. So right here, Honey Industries has provided the machine in January to the customer. If they hadn't provided the machine to the customer in January, it would say that. They don't require the customer to pay, though, until 6 months later. So Honey Industries has earned the revenue as of January, therefore they have to recognize it in January. B, Platt Company collects an advance deposit of $700 in July from a customer toward the purchase of a $3,000 piece of equipment that Platt will deliver to the customer the following September. When does Platt recognize revenue? In July, when they collect a down payment from the customer, or in September when they actually deliver the equipment to the customer? September, right. You guys are getting it. And then C, Naomi Corporation receives payment in October, which happens to be the same time that they delivered a rebuilt engine for a tractor to a customer. When does Naomi get to recognize revenue? There's only one point, in October, right? This is a rare example where they earn the revenue at the exact same time that the customer pays them cash. It doesn't usually happen that way. So in summary, the answer to A was January, answer to B was September, answer to C was October. All right, let's do $13A. This question is, see how it says over here to the right, appendix? So this question is testing your knowledge of the appendix to chapter 3. And I did tell you that the appendix, you're not responsible for that on the exam. However, there will be questions on the homework. At least one question where you will need to know the appendix to answer it. So I figured I'd put one in here about that. In the midst of closing procedures, so we're talking about closing entries now. All right, quick summary. Which accounts are closed? The temporary accounts. What does closed mean? It means you take the account's balance and you make it zero. So the accounts that are closed out to zero at the end of every period are the temporary accounts. And those accounts include revenues, all the revenue accounts, all the expense accounts, and dividends. These are the three types of accounts that would be, their balance would be closed out to zero. So there's two ways to close the account out. You can either close it out directly to retained earnings, or you can close it out to this other temporary account, income summary. And then once you've closed it out to income summary, you close out income summary to retained earnings. So that's what the appendix is about, this income summary kind of intermediate step, if you choose to do it that way as a company. GAAP allows you to choose either way. You can either use the income summary account, or you just close revenues and expenses and dividends straight to retained earnings directly and bypass the income summary account. Either way you want. So this company uses an income summary account. So you have volunteered to complete the closing of the books. And you find that all revenue and expense accounts have zero balances. They've already been closed out. They've been closed out to income summary. The income summary account has a single debit entry for $320,000 and a single credit entry for $352,000. So what would that look like? Let's make a T account for income summary. The revenue accounts and the expense accounts have already been closed to this account because they have zero balances, it said. So when you close the expense accounts out to this account, expense accounts have normal debit balances. So to make their balance zero, you're going to have to credit them, right? You credit the expense accounts, you debit income summary, and the total debits to income summary to close out the expense accounts, it said were $320,000. Then there was one credit in income summary for $352,000. This was to close out the revenue accounts. Revenues have normal credit balances. So to make their balance zero, you have to debit them. And if you debit them, you have to credit something, credit income summary. So this is the total revenue and this is the total expense, basically. This is why companies use sometimes an income summary account, because you can clearly see the total revenue, total expense, and the difference, which is net income. And so the ending balance in income summary is a credit balance of $32,000. Revenues exceeded expenses by $32,000. This is the net income. If expenses had exceeded revenues, income summary would have an ending debit balance, and that would be called net loss. All right, so that's what we have. What else? The dividends account has a debit balance of $17,500, and the retained earnings account has a credit balance of $120,000. Prepare the closing journal entries. All right, let's go look at the dividends account. So revenues and expenses have already been closed. Dividends we need to close, and income summary we need to close. Dividends are sitting there with a $17,500 balance. And then retained earnings is sitting there. Remember, dividends have a normal debit balance. That's why I put the 17.5 on the left. Retained earnings have a normal credit balance, right? They're an owner's equity, they have a normal credit balance. And their ending balance is 120,000. We'll put that over here on the right, credit side. So what journal entries do we need to make? Well, we need to close out dividends. So we're going to need to credit dividends. And debit retained earnings. Whoops. So we can close out dividends to the retained earnings account. So now dividends will have a zero balance. Finally, we have to close out income summary. If it has a credit balance of 32,000, we're going to have to debit income summary so that it now has a balance of zero. And what do we credit then? Credit retained earnings. Eventually, all the temporary accounts are eventually end up being closed out to retained earnings. So retained earnings has an ending balance of, I believe, 134,000. So the journal entries we had to make to complete the closing process were two journal entries. Credit dividends, debit retained earnings, debit income summary, credit retained earnings. So again, debit retained earnings, credit dividends. This closes the dividends account out. And then to close the income summary account, we would debit income summary, credit retained earnings. So those are the two journal entries that they want. These two journal entries complete the closing process. All right. Let's do problem 3.6a. And then if we have time, we'll do 3.8a. So problem 3.6a, let's go ahead to the problem section. Oh, one more page. Here's problem 3.6a. So it says the following selected accounts appear in the Bullard Company's unadjusted trial balance as of 12/31, which is the end of the fiscal year. All accounts have their normal balances. So it gives the ending balance before any adjustment in each of these 6 accounts. It doesn't tell you if it's an ending debit or ending credit balance. You should be able to figure out from your knowledge of dealer and the rules of debit and credit, which, like prepaid advertising, it's an asset, so that $1,400 ending balance is on the debit side. Unearned service fees, it's a liability, so its ending balance of $5,400 is on the credit side, for example. So you have to kind of, they don't tell you that here. You have to kind of know that. All right, prepare the necessary adjusting entries as of 12/31, assuming the following. So that first thing, prepaid advertising at the end of the month should be $950. It was $1,400 at the end of the month, but that was before any adjustment. Now after adjustment, it should be $950. So what's the adjustment? Sounds like we need to make an adjustment for advertising expense. So we take prepaid advertising, make a T account. This will look familiar to you. There's the balance before adjustment. That's what it needs to be after adjustment. And we must take some amount out of that account. And that amount is the advertising expense. And that is equal to $450, it looks like. Here's the journal entry that they want. Again, to solve for x, we just take the 1,400 minus x has to equal 950. Solve this equation for x, that implies x equals $450. And then I can tell you, prepaid advertising, what is that? That's just like prepaid prepaid rent, prepaid insurance. So you're a company, you want a local television station to air a commercial for your product over the next year, and you work out the terms like the commercial will air once every 2 hours, every day of the week, so whatever the terms are, but you want them to air a commercial for your product for the next year. So you pay them $1,400 in advance. Or you pay them some amount in advance. And then as time goes by, at the end of the first month, your commercial's been on the air for that whole month. So you've derived the benefit from that. So you recognize advertising expense and you reduce prepaid advertising by the corresponding amount. So that's the logic for this. Those are the economics behind the transaction. Unpaid wages earned by employees in December are $1,800. Oh, we have a question. When you say, would this be an accrued example, Vince, do you mean would number 1 be an accrued example, or are you asking about number 2? Number 1. No, this would be an example of a deferral. We already paid the prepaid advertising in advance. We debited prepaid advertising $1,400. We credited cash $1,400. We paid the television station. Cash came first. Then later, when a month goes by and our commercial has been on the TV, we've derived the benefit from that. So we've recognized the advertising expense, and our prepaid advertising should go down by the appropriate amount, right? Because this amount represents the right, the 1,400 or whatever represents the right we have for our commercial to be on TV. But after 1 month goes by, part of that right has disappeared, and so we have to reduce it. And so this journal entry here that you're looking at on your screen is a deferral. Cash first, expense happens later. Like when we pay for the commercial in advance, have we incurred an expense yet? No, because we haven't derived any benefit from it being on TV yet. Nobody's seen it. Nobody has seen the commercial. It hasn't happened yet. But then now once people have seen it, once time has gone by, then we've derived benefit from that. Then That's the definition of incurring an expense. That's the definition of incurring an expense. Deriving a benefit from using an asset. Chun-Li asks, should there be a journal entry that debits cash and credits advertising expense? For number one, if the company debited cash, that means they received cash. And crediting an advertising expense? No, that's not. Before this journal entry, Chun-Li, I told you the journal entry. They debited prepaid advertising and they credited cash when they paid the television station in advance for the right to have their commercial air on the local channel. The television station owns the channel. They have the right, they're the ones that the company has to pay them. Do you want me to write the entry? Prepaid advertising would have been debited and cash would have been credited. This happens first, and then this happens. So yeah. You would never credit an expense. The only time you credit an expense is if you're fixing some error in a previous journal entry or you're closing out the expenses at the end of the period to zero. But no adjusting entry will credit an expense. It'll always be either a debit to an expense or a credit to a revenue. You'll never debit a revenue unless you're closing out revenue, unless you're fixing a previous error. I've said that before. Every adjusting entry, of which this one is, involves it's an either or statement, either a debit to an expense or credit to a revenue, but not both. You would never debit an expense and credit a revenue in the same adjusting entry. Prepaid insurance at December 31st is $2,750. This is just like the prepaid advertising. Oh, I didn't do the second one, I'm sorry. Unpaid wages that have been earned by our employees in December are $1,800. This is, we owe our employees wages, so we have wages payable, and we've derived the benefit from them working for us, so we've incurred the expense. Debit wages expense, credit wages payable. Three is just like one. Instead of prepaid advertising, we have prepaid insurance. So make a T account. We paid some amount in advance to be insured. We would have debited prepaid insurance, credited cash. And then when time goes by and we're insured over that period of time, then we've derived the benefit from being insured. Now it's time to debit insurance expense, credit prepaid insurance. The question is for how much? So prepaid insurance was a balance of $34.20 before any adjustment. It says after adjustment, or it doesn't say that, but that's the implication. The $34.20 is the balance on December 31st. And then it says the balance on December 31st is $2,750. So that means after adjustment, obviously. So it should be $2,750 after adjustment. That's the only thing it could mean. So that means we adjusted it, and we can solve 3420 minus x equals 2750. Like I said, it's just the same process that you use for the advertising. All the prepaids work like this. Prepaid rent, prepaid insurance, prepaid advertising. You're going to need to find advertising expense, rent expense, and insurance expense by figuring out, how much went out of the account that period. What is this? It equals 670, I believe. You do the math. So debit insurance expense. Credit prepaid. I'm sorry I abbreviate a lot, but it saves time and space. but I say the words whenever I'm abbreviating, so at least, and you can watch the video later, so at least you know what I'm writing. Prepaid insurance. For unearned service fees at the end of December are $2,800. You say, wait, unearned service fees at the end of December, it said were $5,400. Well, this $5,400 must be the balance in the account before adjustment, and the $2,800 must be the balance in the account after adjustment. Let's make a T account. This is a liability, right? Because of the word unearned. Some customers have given us money in advance for services that we have yet to perform. The dollar value of that stuff before adjustment is $5,400. After adjustment, the dollar value it said was $2,800. And so we must reduce the account by, well, I wouldn't put the answer. We must have reduced the account by some amount. What's the only way to satisfy our unearned service fee liability? We have to earn it, right? We have to do the services. So the only way we're going to reduce the liability is if we've earned the revenue. So credit service fee revenue, debit unearned service fees. That's the journal entry. Question is for how much? Solve for it. 5,400 minus x has to equal 2,800. So that implies that x equals 2,600. So the journal entry is debit unearned service fees, 2,600, and credit service fee revenue. And then finally, number 5. Rent revenue of $1,250, which is owed by a tenant, is not recorded at December 31st. Now this one's a little bit tricky because rent doesn't usually work this way. It turns out in number 5 that we have a particularly nice landlord. Do landlords usually allow you to rent an apartment for a whole month and then collect the money at the end of the month? Or do they usually want you to pay first for the month in advance? Usually they want you to pay first. Rent is usually a prepaid sort of thing. So number 5 is from the standpoint of the landlord, not the tenant. We've been used to thinking about rent from the standpoint of the tenant. But here it's the landlord. So usually the way it works is at the beginning of December, the landlord receives cash from the tenant, right? They debit cash for $1,250. They should debit cash for $1,250, and they credit unearned rent revenue, a liability. They have a liability to allow the tenant to live in that space for the next month. Then at the end of the month, when the month's over with, they've satisfied that liability, so they debit unearned rent revenue, and they've earned the revenue because they provided the space for the client for the tenant for that month. So they credit rent revenue for $1,250. So you would think that the journal entry on December 31st is debit unearned rent revenue, credit rent revenue. We are going to credit rent revenue. We've definitely earned it. We've let them live there that month. But in this case, we're not going to debit unearned rent revenue because of the word it says owed. What we've done is we've allowed our tenant to occupy that space for the month without paying for it. So they still owe us. So we're going to debit rent receivable. They haven't paid us in the past, and they're not paying us now. They still owe us, but we have let them use that space for the month, so we've earned the revenue. So the journal entry is debit rent receivable, credit rent revenue. You would not see this journal entry very often by a landlord. They don't usually, I mean, the fact that we're crediting rent revenue means for sure that they've let the tenant occupy the space, because they can't recognize the revenue before that because it hasn't been earned yet. So they definitely let the tenant occupy the space. But then they're debiting rent receivable, which means they haven't received the money yet for allowing the tenant to do that, when they don't usually do that. If I don't pay my rent, what's today? September 17th. I have to pay my rent for the month of October, no later than October 5th. And if I pay it on October 6th, I have to pay a penalty. And if I don't pay it at all for the first 10 days of October, then according to my lease, my landlord can kick me out. That's how rent works. So this is a rare example. All right, let's do the last one. We have 14 minutes, so we may have enough time to do the last one. If we don't get through the entire last problem, I will still put the entire solution on this document and upload it to Blackboard. So let's go through this. Looks like we may have had a question. I'm going to try to get to the questions here. Just a second. Let's see, what kind? You have a question? Oh, no new questions. All right. So here's the problem 3.8. The adjusted trial balance is shown below for Sharp Consulting Service as of December 31st. Byron Sharp, I wonder if that's a typo, because Byron usually isn't spelled that way. But Byron Sharp made no capital contributions during the year, so they must be the primary shareholder. They didn't give the Sharp Consulting Service Company any money during the year. That's all that's saying. Okay, fine. So here is a listing of all the company's accounts with their balances. And what do we need to do? Part A, prepare an income statement, and then a statement of stockholders' equity, and then a balance sheet. All right, let's do that. Income statement. Income statement, you start with name of company. Name of financial statement, in this case, the income statement. And then for the year ended 12/31, and it doesn't tell us what year it is, it just says that it ends on December 31st, so we'll just put XX because we don't know exactly what year. Now, income statements would start with the revenues. So in this case, there's only one revenue. If you look at all these accounts, only one of these is a revenue. It's the service fees earned. $62,600 this year they've earned in service fees. So that's the revenue. And then we have our expenses. There are several expenses, so I'll put a category here, expenses. And then what are the expenses? We have rent, salaries, supplies, insurance, depreciation, and interest. So rent, salaries, supplies, what else? Insurance, depreciation, and interest. And I don't like this S. That's kind of a weird S, so let's make it better. All right, and then the amounts. I mean, technically, I should put the word expense after all these, but to save on time, I'm not going to do that. So the rent was what? $15,500, $15,500, $33,400, $4,200. Uh, 3250, 720, and 630. Then we get our total expenses. We add up, all of these. And I believe when you do that, you get 57, if I can recall, 700. And then we subtract our total expenses from our total revenue. And if we get a positive number, which we do in this case, that's called net income. And if we get a negative number, then that's called net loss. And we put parentheses around it. But it's a positive number. It's equal to $4,900. And that's our net income, double underline. So that's our income statement this year. All right, let's do the statement of stockholders' equity. I think we have enough room right here. Statement of stockholders' equity, again, it's a financial statement, so it has to begin with the same type of heading like this. So I'm just going to copy and paste this down here. Maybe put it right here, give myself some more room. Maybe move this up a little bit so I have room to finish it. And then we got to change this to say the statement of stockholders' equity. All right, statement of stockholders' equity. We have we take our stockholders' equity and we break it into two pieces: common stock and retained earnings. I should probably move this over. And then we basically just track the change in these two accounts. So we start with the beginning balance. Now, what's the beginning balance in common stock? These are the ending balances. This is the ending balance in common stock, 7,200. What was the beginning balance? Let's see. Talk about that. We know that there was no capital contribution during the year, so there was no addition to common stock during the year. It doesn't give us the beginning balance. So if it doesn't give you the beginning balance, you just assume the beginning balance is 0. There were no additions. To common stock, there were no additions. There were no subtractions. And so the ending balance is whatever it told us. I think it said 7,200 on the adjusted trial balance. 7,200. Now, retained earnings has an ending balance of 2,800. Its beginning balance is 0 because it didn't tell us. What do we add to our retained earnings beginning balance? We add net income. And net income from our income statement was 4,900. And what do we subtract from our retained earnings? We subtract dividends. And does it tell us what the dividends are? $2,900. Oh, that's going to help us get our beginning balance. We know the ending balance is 2,800 because it says that. Oh no, it's 5205. Sorry, 5205. I don't know, I wrote the wrong number here. From the adjusted trial balance, the ending balance and retained earnings is 5205. Is that right? Retained earnings, yeah, 5205. Common stock's ending balance was 2,800. I'm writing the wrong numbers down here. Common stock was 2,800. Sorry about that. My apologies. We know net income is 4,900. We know dividends were 2,900. Does 49 minus 29 equal 5205? Most certainly not. So that means the beginning balance of retained earnings, we could solve for it. Something plus 4,900 minus 2,900 equals 5205. I think that would be 3205. Would have to be the beginning balance. So I'll put a little star by this. Remove this. And then we have our total column. Now, common stock may have a different beginning balance than 0. But we don't know for sure. So we'll just put 3205. We'll put 4,900 here. Subtract 2,900 here. And so our total ending balance well, we must have, let's see, there were no capital, okay. All right. The beginning balance in common stock must have been 2,800. What am I thinking? There were no capital contributions during the period, so there was nothing added. It told us that. And the ending balance is 2,800. So there we go. My bad. So the beginning then was 3205 plus 2,800, which is what? Trying to do math in my head. Let's do it really quickly with the calculator so I don't mess up. 3205 plus 2,800 is 6,005. Right. So at the end, I should have 2,800 plus 205, 8,005. So this 8,005 is the total stockholders' equity as of the end of the year. So there's our statement of stockholders' equity. Now, the only thing I haven't done is I haven't completed this little. How did we get that? We got that by saying X plus something plus the beginning balance plus 4,900 minus the dividends had to equal the ending balance, which was given to us. And then that implies that X equals the 3205. That's how we got the 3205. So this is how we get the 3205. So there's our statement of stockholders' equity. And now let's go do the balance sheet. And I'm going to run out of, I'm going to go past 240 slightly. So if you have to go, that's fine. But I'm going to finish up this problem because I am recording so that I can upload a complete recording to YouTube. Or not part C, but let's do the balance sheet now. We're still on, we're still on part A. I don't know why I put part B over here. We're still on part A. A is to do all the financial statements except for the statement of cash flows. So let's do a balance sheet. Let's see, let's paste this here and just change this to say balance sheet. So get rid of this, it should say balance sheet. And the balance sheet is not for a particular period of time, it's as of. So as of, snapshot at a moment in time. The balances just carry over from the previous year. So we're going to have our assets. We're going to list our current assets first in order of liquidity. So we're going to have cash, accounts receivable, supplies, prepaid insurance, cash, accounts receivable, supplies, prepaid insurance. These are our current assets. Then get a subtotal. Then list our long-term assets, which would be the equipment, and then the accumulate, and then we have to put underneath it less the balance in the accumulated depreciation account, because that's a contra account to the equipment. Or I don't have to, I can just say less accumulated depreciation. Probably want to move these over a little bit. Need more room here. And then the equipment minus the accumulated depreciation is called the net equipment. And then our current assets added to our net equipment, since our net equipment is the only long-term asset, will be our total assets. And we will double underline our total assets. So let's go ahead and put the numbers in for that. So cash was 2,900, then we had 3,270, and then 5,060. And then prepaid insurance was 1,500. Equipment was 6,400 minus the balance in the accumulated depreciation account of 1,050 or 1,080. Make sure I got those right. 6,400 minus 1,080 is 5,320, I believe. So let's get our total current see what our total current is. 2,900, 3,270, it's 5,060, it's 1,500, 12,730. Add the 12,730, that's our current assets, to our long-term assets of 5,320. And that gives us total assets of $18,050. Now we go make the liabilities and owner's equity section, and the sum of those should equal $18,050, or else we've made a mistake. So let's do liabilities now. Our liabilities are accounts payable. That's the only current one. And long-term notes payable. That's the only long-term one. This is really easy section. So 845 and 7,200. Usually you would have a current liabilities and total current, but there's only one of them, so you don't have to do all that. Accounts payable, and then long-term. What does it say? Long-term notes payable. Notes payable usually is long-term, but there are some notes that are short-term, like if the bank allows you less than a year, or not allows you, but forces you to pay the loan back in less than a year, then it's a short-term liability. The year is the deciding thing, year or less. And then what do we have? 7,200. Now we can get a total liabilities. So 845 and 7,200 looks to be 8,045. And then finally, the stockholders' equity. section?
Would 8,045 be double underlined?
No, because we're going to add the 8,045 to the total stockholders' equity to get the total of both of those.
Gotcha.
And the two double underlined things should be equal to each other, which would be the assets and the sum of liabilities and owner's equity. So we'll get to that here down, but good question. So stockholders' equity, then we have our common stock. And we have our retained earnings. And then according to our statement of stockholders' equity, this common stock ending balance is 2,800, and we got that from the adjusted trial balance. And the ending balance from retained earnings is 5,205, 2,800, 5,205. And you sum those numbers, and we should get the $8,005. So this is the total stockholders' equity. And then finally, the total liabilities and stockholders' equity is the 8,045 plus the 8,005. And it looks like we've made a mistake because those two numbers sum up to 16,050, not 18,050. The question is, where did we make our mistake? I wonder if anyone can see our mistake. Did I do the right 5,060, 1,500, 6,400? Maybe I added, whenever I added all this stuff up, maybe I added them wrong. But clearly this number right here, 8,045, that's the total liabilities. That number was right? Plus, this should be 16,050. And this number should be the same. So let me go add up the assets again and see if I messed up there, because I think that's probably where I messed up. Let me do it again here. 2,900 plus 3,270 plus 5,060 plus 1,500 plus the 6,400 minus the 1,080 is 18,050. All right, at this point, we go to the solution and we figure out what did we do wrong. I'm sure it's something very minor. Let's go figure it out. That way we make sure we get you guys with the right answers and not the wrong answers. So this is problem 3.8a. So it's probably way down here, somewhere towards the end. The solutions, we will get there. I went past it. Let's see, 315b, so we gotta keep going. Yeah, we're still in the B's. All right, now we're in the A's. No, not in the A's yet. Keep going back. Getting there. All right, it's right back here. So I did the asset side correctly. Here's the balance sheet. And on the liabilities and owner's equity side, that's where I messed up. I messed up in one spot. Retained earnings has an ending balance of 7,205, not 5,205. Why is that? Let's go back. So this should be, I had made one mistake. Retained earnings should be 7,205 and not 5,205. which would make this 10,005, which would make this 18,050. Now, why is retained earnings 7205? It has to do with this here. Let's go look at the key again. When they did the statement of stockholders' equity, what did they do? Oh, okay. I think the ending balance in retained earnings is given to us on the adjusted trial balance. So if we go back to the adjusted trial balance and you look at retained earnings, wait, it says 5205 credit. Ah, this is something I have to point out to you all. This is something I forgot to tell you. Okay. On the adjusted trial balance, every account listed on the adjusted trial balance, that is its final balance other than retained earnings. Retained earnings is the only one where you have to further adjust it. That's the one thing that I actually knew but forgot to tell you guys because I forgot myself. So this balance that it gives you on the adjusted trial balance, you got to put that as the beginning balance to retained earnings. Or it's the balance before adjustment. It's the balance as of 12/31. It's not the balance as of January 1st. It's the balance as of the end of the year, but before you adjust it for net income and well, it is the balance on 1/1 because you wouldn't have made any changes to it between 1/1 and 12/31. So it's 5205 is the balance, and then we make the adjustments for net income and dividends to get the ending balance of 7205. That's the real ending balance of retained earnings. That's the adjusted ending balance of retained earnings is what I'm trying to say. And then everything works out. So that's that. And in part B of this problem, so we finished the 3 financial statements. And it says prepare closing entries directly to retained earnings. So to do the closing entries, we have to close out all of the revenue and expense accounts and the dividend account, those 3 accounts. There's only one revenue account. There's service fees earned. Revenues have a normal credit balance. So we got to make that account have a 0 balance. So we're going to debit service fees earned. So now that account will have a 0 balance in it. And we're going to credit retained earnings. Then we're going to close the expense accounts. So the expense accounts are all these accounts here. They all have debit balances. So we got to credit all the expense accounts for their balance so that their balance will now be 0. And then debit retained earnings. So if you just want to credit expenses, 57,700, and then debit retained earnings. I mean, technically you should credit here. You should credit each one separately. So we'll just do that. And then debit retained earnings. That closes the expense accounts. So we know the total of the expenses was 57,700, and rent expense, salaries expense, supplies expense, insurance expense, depreciation expense, interest expense. And the numbers were, I can just copy and paste them. They were these numbers, right? Where's the income statement? These numbers right here. So we're closing these accounts balance to 0. Like that. That closes, this journal entry closes out the revenue account. This journal entry closes out all the expense accounts. We need to make one more journal entry to close out the dividend account. So dividends have a normal debit balance. So to close them out, you have to credit them, which means you debit retained earnings. And how much were dividends? They were 2,900. And so to summarize, if we look at the retained earnings account, its balance at the end of the year before any adjustments is listed on the trial balance. It's 5205 right here. That's its balance before any of these adjustments. Then what did we do? The first adjustment was to close out the revenue account. So we credited retained earnings for 62,600. Then we made an adjustment to close out the expense account. So we debited retained earnings for 57,700, which reduces its balance. And then we reduced retained earnings for the dividends. And so after these closing entries, retained earnings has its balance of $7,205 at the end of the year. All right, finally, we're done with this problem, and hopefully for you all who stuck around that it made sense. And I'm going to upload this to YouTube, the video, and upload this document to Blackboard. So I'm going to stop recording.